Welcome everyone, and thank you for joining me today. I'm excited to present an overview of Zee Learn Limited, a company in the education services sector. On this first slide, you'll see some key details including the current market capitalization, stock prices, and our one-year target. Over the course of this presentation, we'll analyze the stock, discuss its potential, and explore what the next year might hold for Zee Learn. Let's get started. Let's take a closer look at some of the key financial metrics for Zee Learn. The delivery percentage stands at 69.75%, which indicates a solid level of operational efficiency. The promoter holding is approximately 15%, reflecting the ownership stake held by the company's promoters. The price-to-book ratio is around 1.16 times, suggesting that the company's market value is slightly above its book value. Meanwhile, the price-to-earnings ratio is 4.69 times, which can give us an idea of how the market values the company's earnings. The book value per share is Rupee 5.39, providing an insight into the company's net asset value on a per-share basis. Earnings per share, or EPS, is Rupee 1.70, indicating the profit allocated to each share. However, it's important to note that the net profit for the second quarter of fiscal year 26 is negative, at minus 6.14 crore rupees, which reflects some challenges during that period. On the bright side, the revenue over the trailing 12 months is robust at 421 crore. Now, looking at the company's overall profile, Zee Learn was incorporated in 2010 and has established itself as a leading education services provider. It operates Kidzee, which is one of India's largest preschool chains with around 1,900 centers across over 750 cities. They also run Mount Litera Zee schools, which are K-12 international standard schools, and they offer Mount Litera World Preschool, a premium early learning program. Zee Learn's segments include educational services, construction and leasing for education facilities, and training and manpower development. The company has a broad geographical presence, not just in India, but also in the Middle East, Africa, and the USA. All these points highlight Zee Learn's significant role in the education sector and its diverse operations worldwide. Let's walk through the basis and rationale behind our target price. Starting with the upside potential, we're looking at a scenario that aligns within the analyst range and matches the 2026 upside consensus of approximately 13.47 rupees. This indicates a significant opportunity, with an upside of over 100% from the current levels. Speaking of targets, our specific target is 12 rupees, which is supported by the 2026 analyst high, and a discounted cash flow fair value of around 20.40 rupees. This also factors in the recovery we expect in the preschool segment. The bullish case is even more optimistic, based on the median estimate from 57 analysts, with a DCF undervaluation of about 69%, suggesting an upside of around 145% to 14.70 rupees. On the more conservative side, the base case takes support at a price range of 457 to 7 rupees, considering the current weak earnings momentum, and still expects a modest upside of around 14%, which brings us to roughly 6.85 rupees. Finally, the bear case is built on a combination of analyst consensus, DCF valuation, and technical levels, providing a more cautious outlook. Overall, our target price is set at 12 rupees, with an upside potential of over 100% from the current market price, which is around 5 to 6 rupees. This analysis over the next year underscores the significant growth potential based on various scenarios and valuation metrics. Let's take a closer look at the price target range, which we're calling a visual snapshot of our expectations. What this really means is that we're providing a clear, visual representation of where we see the company's stock heading in the near to mid-term. It's important to understand that these ranges are based on thorough analysis, including market trends, company performance, and broader economic factors. The key point here is that these targets aren't just random numbers. They reflect our confidence in the company's growth potential and the potential risks involved. By visualizing this range, We're offering a snapshot that helps investors gauge the possible upside while also being aware of the downside. This ties into our overall theme of strategic planning, being prepared and informed. It's about giving you a solid framework to make decisions, understanding that while the future isn't set in stone, our analysis helps us set reasonable expectations. So, keep in mind that this range is a dynamic tool, something to monitor and update as new information becomes available. Let's take a closer look at the analyst consensus for this stock, based on the opinions of 57 analysts. First, the high return on equity, or ROE, stands out as quite impressive, with a historical figure of 41.3%. This indicates that the company has been very effective at generating profits from shareholders' equity over time. Now, when we see a ROE below 1, it often suggests that the stock might be undervalued, and in this case, the PEG ratio is only 0.41. A PEG ratio below 1 typically signals a potential value opportunity, meaning the stock could be trading at a discount relative to its growth prospects. Looking at the stock's valuation, it's near its book value, which is Rupee 5.39 per share. Being close to book value suggests the market perceives this stock as fairly valued or even slightly undervalued, especially if the company is fundamentally sound. The positive earnings per share, or EPS, at Rupee 1.70 further supports that the company is profitable. When the stock is near its book value with a low premium, it can be an attractive buy for value investors. The P/B ratio, or price to book, is 1.16x, indicating the stock is trading just above its book value, again pointing to modest valuation levels. Meanwhile, the P/E ratio is 4.69x, which is quite low. This often signals that the stock might be undervalued or that there's a potential for upside. Looking at the key valuation metrics, our discounted cash flow estimate suggests a fair value of around Rupee 20.40. This implies that the stock is currently undervalued by approximately 69.5%, considering its current price of Rupee 5.81. Overall, these fundamentals point toward a potentially undervalued stock with solid profitability and reasonable valuation ratios. It's worth considering how these factors align with our overall investment theme and strategy. Now, let's look at our diverse business segments and growth drivers. First, we have our corporate and vocational training services, which include EdTech and e-learning solutions. These services target international markets such as the Middle East, Africa, and the USA, helping us diversify our revenue streams beyond the traditional K-12 segment. Next, our training and manpower division focuses on building and leasing school infrastructure, creating long-term, annuity-style revenues. This supports both our own owned schools and franchisee schools, and the asset base we develop adds to our overall book value. Moving on to construction and leasing, we offer a K-12 curriculum aligned with international standards. Our premium positioning in Tier 1 and Tier 2 cities helps us capitalize on the growing demand for quality education. The partnered school model we employ allows us to reduce capital expenditure while expanding our reach efficiently. Now, talking about our flagship schools, Mount Litera Zee Schools, we have around 1,900 centers across more than 750 cities. This makes it the largest preschool franchise network in India. Our franchise model is asset-light and scalable, which is a key driver for revenue recovery and future growth. Finally, we have Kidsy Preschools, which complement our offerings by expanding our footprint early in children's educational journey. Together, these segments form a robust foundation for sustainable growth, driven by increasing demand for high-quality education across regions. Let's look at some critical points about this company. First, it's important to note that the company has never paid dividends and currently has no plans to do so. This indicates that it's primarily a pure capital appreciation play, meaning investors are expected to benefit mainly from stock price increases rather than income from dividends. Moving on, there's a notable risk related to competition. The company faces growing pressure from EdTech firms, private schools, and new preschool chains, which could squeeze margins over time. This increased competition poses a medium-level risk to the company's profitability. When we examine the stock's recent performance, it has fallen from a high of around Rupee 10.89 to approximately 5. The short-term technical trend remains negative, suggesting that the stock could continue to face downward pressure in the near term. Another concern is the promoter stake, which is just 15%. This is relatively low and might indicate limited skin in the game, or it could point to pledging risks, which can sometimes lead to instability or concerns among investors. Looking at the financials, the company's revenue has been under pressure, with a compound annual growth rate of -6.3% over the past 5 years. The latest trailing 12 months revenue stands at 421 crore, but the persistent top-line pressure remains a concern. On the profitability front, things are more troubling. Net profit in Q2 FY26 fell by over 52% year-over-year to a loss of 6.14 crore. Over the last 5 years, losses have been widening at an average rate of about 86.4% annually, which is a serious red flag. Overall, these factors highlight significant risk elements: weak sales growth, widening losses, and a declining stock price, all of which need to be carefully considered before making any investment decisions. Let's take a moment to review the key points on this final slide. First, a quick disclaimer. This presentation is for informational purposes only and does not constitute investment advice. It's important to keep in mind that this opportunity is suitable for high-risk investors with at least a 12-month horizon. The stock carries a high-risk profile because profitability recovery is a crucial catalyst for upside potential. Essentially, losses need to reverse for us to see sustained gains. On the bright side, there's strong analyst consensus. 55 out of 57 surveyed in the last 3 months are recommending a buy. That's quite a bullish signal. Additionally, the company's strong franchise network, including brands like Kidsey and MLZS, provides a steady stream of recurring revenue once losses are behind us. This adds a layer of stability to the growth story. From a valuation perspective, the stock is currently about 70% undervalued compared to its discounted cash flow fair value of around Rupee 2040. This offers a compelling long-term margin of safety for investors willing to hold through the volatility. And looking ahead, a target of Rupee 12 over the next year is quite achievable. It sits within the analyst bullish range of approximately 14.7 and above the base case of Rupee 11.25, making it a realistic goal. So, in summary, while there are risks involved, the potential rewards, supported by strong analyst confidence and undervaluation, make this an interesting opportunity for the right investor willing to adopt a longer-term view.